Hi everybody, it's Mark here at Teslary, and I'm really sorry I couldn't get this video up yesterday. I was working on the Jim Cramer versus Adam Jonas one that I uploaded last night, but let's get to it. So Tesla closed red today, and it was a little bit red. It was at $274.39 at the end of the day, which was a drop of $1.65 per share, or just 0.6% down from yesterday's close. When considering the rest of the stock market, Tesla really did outperform in kind of in that weird way that even though it was red, it wasn't as red as even say the S&P 500, which was double the amount of in losses percentage wise. So I think as Tesla shareholders, we can kind of be happy that even though after Monday's really big explosive move, we haven't gone anywhere. As you can see, we're basically flat for the entire week. But we'll take it, right? A 10% week, that's a 10% week. And we're typically only expecting like on an upwards move for a week at the maximum, maybe 5% on a typical week of Tesla. So let's just say we just doubled the performance in the best case scenario. There are some really obvious opportunities when it comes to Tesla when it's kind of in a range or there's consolidation. And that opportunity is really the open. If it's really, really bullish and it's going to be either gapping up in the morning like it did yesterday, or if it gets bought up really severely in the morning, there's going to be a point in time where that profit taking takes place, or really just, people wanting to get out of their positions for the sake of de-risking. And so here's some examples of that. Early in the morning on Tuesday, you saw a very sharp increase in the morning. Within a couple of minutes, you're up 3.76%, only to go ahead and sell off for the rest of the day. And that was a 4% drop. How about the next day thereafter? So it's going to be almost 3% gain in the morning, and it sold off almost completely within a couple of minutes. Now, by the end of the day, that sell-off wasn't as severe, but it's still a play and it's still an opportunity to get a hedge in if you're kind of looking at some certain levels. Now, the level we were watching yesterday was around 280. So when it got to 279, that was actually the moment it started selling off. Catching that you would have to be so fast. Some of these moves are finished within a couple of minutes. And so when it comes to just being a gap up, let's just kind of expand the chart here. And you could see in the morning that gap up wasn't too bad. It was, half percentage. Then it saw another percentage gain over the course of the next 2 minutes. If you had a perfect short there, you would have captured a really, really good move to the downside over the course of the day, which would have been, at the maximum about 2.5%. But it's just not that day. We had it on Tuesday, we had it on Wednesday, and getting those plays in during the course of the week. And it doesn't really have to be like a short or a put. Really, what I think that if you are a large shareholder of Tesla, those are some opportunities to sell calls against shares. And you would have actually been like making out like a bandit. Like if you would have just sold at the high on Monday or Tuesday, you would have been sitting pretty for 5 days of just, theta burn on the options that you sold. It would have been really, really effective. And given the opportunity, you can, if you can capture that low that we had on Friday, you could use that Friday low to get in what we talk about all the time, the hedge for any upside movement. For example, it's just a calendar spread. We talk about it a lot. If you have, a bunch of calls sold, 3 weeks out, you can buy a call or buy a call for each one of the calls you sold. That's maybe 1 week out or 2 weeks out. So it's a little bit lower, it's a little bit tighter as far as expiration goes, but you get a little bit more volatility that can compensate, allowing you to either, cash in on a good move by selling the call, or selling the call and closing the call you sold for a slight loss if you just want to, maintain your shares. It's a really nice hedge if there's any big news that's going to come up. Now, what's coming up next week? Obviously, the biggest news is going to be FOMC. And there's always that kind of X factor as far as the Cybertruck release date or handover date, or just, details given to people that bought the Cybertruck event ticket on their, points redemption in their Tesla app. If there's any clarity when it comes to that Cybertruck release, that can be a nice catalyst. Would that catalyst likely be sold off in about 1 or 2 days? Probably. But those opportunities are always opportunities to get your hedges in that allow you to, minimize the volatility that you see in Tesla, which is really ups and downs in multiple percentage points within 1 to 2 days. But, overall for the week, I think we should be happy after the upgrade. We kind of maintained that almost like 10% gain on the week, where what was the S&P 500 down like, 0.5% for the week. And there's kind of reasons for that. In the YouTube short I uploaded last weekend, I was talking about some catalysts, and one of the catalysts is the weakness in the market during this time of year. September being one of the worst months for returns on the stock market, and we're going to take a look at that seasonality because I think that's going to be maybe play maybe a role in the potential movement of Tesla stock, even though it didn't really affect Tesla yesterday when the indices are selling off. But also there could be a reason for that as well. And we'll look at charts for Tesla and the S&P 500 when it comes to seasonality. But let's go over to the S&P 500 now. So looking at S&P 500, I highlighted some areas I would just want you to take a quick note of, like a mental picture of. And these are highlighted areas of the end of August to the low in October. So whenever, some type of end to midpoint of August, and then I try to locate a low in the following 2 months. And this is going to be from last year. So this is Jackson Hole, it sells off, and you can see throughout the month, throughout the 2 months, it's generally very, very weak, finding a bottom sometime in October, only for it to rally into the end of the year, usually sometime in the middle of December. So for example, this move would have been 17% on the move from Jackson Hole to the bottom of the bear market. Let's go back another year or so, and this is going to be 2021, and let's take a look at this. So what date is this? So this is, it looks like it tops out at the end of August and the first day of September, and it finds a low. And that low is going to be, let's see where it's at. It's October 21st. So there was a low that was made in October 21st for a 6% move down. And also kind of take note, there was a little bit of a rebound, at the end of September. Can we confirm there's any rebound in the previous highlighted area? We can see that there was a rebound in the middle of September. So there looks like, from just based off what we're kind of briefly reviewing in the chart, that there is a slight rebound in September, but a general kind of bearish move to try to find some type of bottom. Now let's take a look at this. This is going to be 2020, and you can see that there's a high at the beginning of September with a very slight rebound at the middle of September, only for it to continue selling off. And I want you to take note of that as well, that it continues to sell off from the middle of September's high, and it sells off. This is a 10% move to the downside. But if I was to actually let me just get the full candle from the 2nd of September, that's like 10.74% to the downside. Let's go back just another year and let's see what it looks like. So this is a little bit different, where in the middle of August, it was kind of consolidating from a move, and it gets a nice buy into the middle of September. But what happens again at the middle of September? We talked about it from the other slight rebounds. The middle of September has a sell-off, and this was almost 6%, and it bottomed at the beginning of October. Let's go back just one more year, and then we'll stop there. So here is the highlighted area. This is the middle, just the later part of August. And we can say that maybe we have a high, and that high is going to be the middle of September. And what happens in the middle of September? It sells off very hard. This was almost a 12% move to the downside to find a kind of a local bottom in October. Eventually it did sell off even more so in December, but it did rebound going into November, and it kind of made this this is like an obvious bear flag. I think this is a very obvious move in retrospect. So now that we kind of determine the price action is a little bit of buying maybe going into end of August, maybe a little bit of buying going to the middle of September. But what happens after that? It sells, and it's sold over and over for the last 3 or 4 or 5 years. What's the reason for that? Well, I don't know if there's a real strong reason, but I want to show you the seasonality chart that we've looked at, I think, real briefly before. And we can kind of just, this is not horoscope reading. It's just averaging out performance for the index during that time. So here's on equityclock.com. They have a lot of seasonality charts, including one for Tesla we'll look at in a couple seconds. But you can see that in August, there's a peak in August, but there's also a peak in the middle of September. So it goes at the end of August, a slight sell, slight buy up into OpEx, and a sell all the way to sometime in October as a low. This is obvious. I think this is basically, it's in the books for every year. And I'm going to show you another chart in a second that kind of supports the idea that we just got through OpEx and it was really, really bearish. I think, and this is not financial advice, but if you see the opportunity to go short anytime next week, I think it might work out to be a good hedge if you're really long, right? So it wouldn't hurt to grab a couple puts, maybe that expire 1 to 2 weeks, just to cover your butt if you're really, really long or really, really overexposed to a particular ticker, or you just want to have some peace of mind as we go to probably one of the weakest points in the year, over and over and over for the last 100 years. So take note that in the middle of September, it's used that OpEx is going to be in the middle or into the next couple of days from outside of the middle of September. So anywhere from the 15th to the 24th, OpEx is going to be somewhere in that area. After that area has passed, after OpEx has passed, it sells off. So why is that? Well, I think we talked about it in another video. I think, you're going to have a lot of fund managers who have been losing out on this move since the beginning of this year. They don't have any returns to really show for it. Maybe they're heavily into energy, into bonds. We've seen that play get, kind of recover from the energy side over the past couple of weeks, but bonds has been no good, and it had humongous inflows at the end of last year into the beginning of this year, a lot of people thinking that there would have been a recession by now, by Q3, but Q3 is almost over. We're almost going into Q4, and the recession has yet to be found. I'm not saying it's not coming, but the people that position themselves for it, let's say, for example, being heavy into gold, being heavy into bonds, being long bonds, being whatever bonds, it has been a terrible trade ever since spring. So if you're a fund manager, if you are managing other people's money, they have expectations, like they're paying you a percent of their principal. They want to see a return. Unless they're a hedge fund, like if you're just managing people's money and you've been maybe making that same, let's say your money manager was listening to CNBC at the end of last year saying, all these hosts, and you can just look at the videos on YouTube, all these hosts are like, okay, I'm long bonds, I'm long energy. After energy had one of the best performances in its history, I'm long energy into next year, I'm long bonds into next year. Really bad idea, but you're gonna have you have 1 quarter left to show for it. That maybe in October, November, December, that's when they can make their money. You can see in this chart that, it's kind of true, where you see a very strong gain over the last quarter that is very similar to the spring gains on average. So if you miss out on this move, maybe your move as a fund manager, you go heavy long, in the first week to second week of October, and try to just get some performance, so you don't look so bad compared to the index. I mean, that's all you can really compare yourself to, right? But if you just miss this entire move, which on average is 4 to 5%, let's say you miss your 4 to 5% for the year, you need to get that 4 to 5% or even more for the last part of the year. So what do you do? What's the best way to kind of guarantee that return? You go short when it's seasonally weak. You capture a 1%, 2%, 3% move. You you do your best to time a bottom, and you go long for the rest of the year, and you beat the index. That's all you can do. That's your only hope. So let's look at a tweet that kind of showcases that this person has been tracking the S&P 500, and it was for the last 33 years. The majority of those years have shown that the weeks after the OpEx of September have been terrible, just awful. And here's the chart, and here are those returns. So there is five years that there was positive for the last couple of weeks of September, but the vast majority have been very, very bad. And some of those declines are over almost 5% or over 5%. So this could be, if you're heavy long, this could be a great opportunity to, make a little money to the downside, hedge to the downside. If you're short, congratulations. Maybe, starting Friday, it's going to work out really great for you. How do you capture those downside moves? So I want to show you the seasonality of Tesla. So I know you all hold Tesla. Maybe that's your majority holding. So let's say you're trying to short Tesla, but it might not necessarily be, I'm not obviously not financial advice, but maybe it's not necessarily the best move if you're trying to capture big downside for the next couple of weeks. Because looking at Tesla's seasonality, it kind of peaks right at OpEx. That kind of lines up for the move that we had. So we had this really gigantic move. It would make sense, right? So typically this is a say it's like 64% to like an 83% move, that's like a 20% move. That lines up perfectly, right, guys? Like we had the big move. This is lining up perfectly. We saw we saw our peak that we're almost equal to now. So our peak wasn't at the end of August. Our peak was sometime at the beginning of July, June. So our peak was kind of moved over to the left a little bit, but the chart is basically right where you have a strong gain into the summer, and then you kind of realize it as resistance for the next couple months. So what do we glean from this information is that the downside on Tesla could be there for a little bit. It could rebound a little bit sooner, and it might not be as a steep decline as some other tickers in the market. So, going short the index might be just a sure bet to capture some time of downside movement, because what if there's, really great catalysts for Tesla? What kind of those catalysts be that would prevent your downside from working? And basically you're maybe throwing your money away on puts. Think about, I always talk about it all the time. It's like the X factor. When is Cybertruck going to be released? When is the handover date for that? What's the pricing for it? All of those things will be really instrumental in having like a nice move to the upside to really outperform the index over the next couple months. What's the second thing? Are we going to get the Model 3? We're still seeing Model 3, mules and test vehicles out in California. We're hearing about all these like retooling in factories. So Giga Texas is having a massive retool for the past week and maybe might extend for the next week. So maybe a couple weeks modifying the line, obviously maybe to optimize Cybertruck's production, maybe to go ahead and, tweak the Model Y a little bit. And we also saw, of course, in Shanghai, they finished the lineup without us ever really knowing, because they're pumping out Model 3 refresh cars like crazy into the thousands and thousands, which are all being shipped over to Europe. But they finally have approval to sell that Model 3 refresh vehicle in country in China. So that's really, really cool and could help with the volumes that we haven't been really seeing a lot in China. So if we can get those volumes up, it'll be really another great catalyst for another either just like a stabilizing price action for Tesla over the next couple of weeks on average, or if you can see volumes peak, not peak, but go up for the Model 3s over there, it would be fantastic. Also, when we have some clarity as far as like, Elon's been talking about people licensing FSD, it's kind of getting to the point where with the UAW strikes going on, that could be a great catalyst for Tesla. But it also can be a way or kind of some motivation for some other auto manufacturers to look for some efficiencies in the production of their vehicles. It could be, licensing some type of software or hardware from Tesla to kind of, if my workers are, not working, what are the ways I can use this opportunity, this downtime to, adjust my approach to how I'm transitioning to electric vehicles? How can I use this time to retool my manufacturing process? So it could be an interesting catalyst for some type of collaboration with Tesla in the near term, because maybe their hands are being forced because of that. And we'll look at some UAW stuff and look at the GM, the kind of Ford action, because, you get a lot of questions if you're following Tesla that people are like, why is Tesla red today? And it wasn't that red on Friday, but it was a little bit red. But why is Ford, GM, Stellantis, even like VinFast, why are they outperforming Tesla? It's something we want to look at, and we'll look at that when we get back to the charts. So we looked at Tesla seasonality, and I'm going to switch over to the S&P 500 just to kind of refresh your memory. Focus on September. Just focus on that area. You can see how September has like a couple highs, around August, September, October. These have equal highs. Let's look at, again, S&P 500. So you have kind of an equal high to the August and September, and then nothing good in October until you get a bottom and you try to capture a move, kind of sells off into November, gets bought back up again into December, and you find some resistance when it goes into the middle of December. So something to keep in mind, that the downside move maybe isn't there for Tesla, but obviously the way that they hedge for Tesla, I think, is always like, they're selling those covered calls and managing them. You need to manage them, because a lot of people, when the shares are called away because they weren't actively managing their trade, it's disappointing, because sometimes the moves you lose out on is multiple percent over what your call is sold for. Because if you sell calls, you probably know the premium isn't that great unless you're getting really close to the money. Then, the volatility for stocks isn't there. Even after a nice move on the VIX on Friday, not nice. I don't like the move, but even though there's a big move on VIX on Friday, options are still not returning a great premium because you're kind of locked into this thought process that during the really volatile year of 2022, VIX being on average like over 20 all the time, you were getting really nice premium on any type of option that you were selling, puts or calls. But now it's really not there. So if you're trying to get some type of hedge on Tesla and you're looking at these dollar amount, these premiums that you're trying to get a return on, maybe they're not that great looking. So people tend to maybe sell closer to the money calls, and just to get that premium, also a hedge for the downside, they want a greater hedge, which is really, really cool. And we've talked about ways to kind of hedge that upside risk. But yeah, so they're selling calls close to the strike close to the actual underlying value of Tesla shares. And when they get called away because, the move that they just lost out on was like 20%, they were only factoring in move for 3 to 4%. They're losing out on many, many percent. And it does make you feel bad. But I always say all the time, selling calls is great to hedge your risk. But at the same time, whenever you sell a call, whenever you sell a put, you need to understand you're actively trading Tesla. You're not just an investor, you're actively trading. And you have to kind of you need to actually act that way, that you're actually, needing to follow the price action on a constant basis. Now, some people say, I really don't have time to look at the stock. Well, you do. You just need to make time because your investment is riding on it. So we look at the tweet that had that kind of really bad seasonality going to the end of September after OpEx. OpEx passed. And I'll just address OpEx real quick. It was a really big move to the downside, right? And it caught a lot of people off guard. And I don't think anyone's necessarily expecting it, but I think that the premise of it is, I say it all the time, it's not a great trade sometimes on OpEx because it's kind of maybe going counter to what you're wanting to do, which is perfect for the market makers. They gave you a lot of opportunity to close out your calls on Wednesday and Thursday. But if you stayed long, you got burnt because it's a big gap down, which continues to sell off all day long. And what I want people to understand is that you don't know how they're positioned. You don't know what they need the price of the stock to be at. And you don't know if it scare people unnecessarily. Because the SPX had an AM expiration. And we talked about the AM expiration a couple of days ago. That you might, if the expiration, that's the quote unquote max pain for that early morning expiration, if it's lower than what the price was yesterday, you might see that kind of drift down in the futures market. In the pre-market, what happened? It drifted down and it started selling very sharply towards the expiration at 9:15. I think it scared a lot of people, where it kind of created this kind of cascading effect because, it was kind of below the generally accepted, quote unquote, max pain for other tickers, be it SPY, be it the NASDAQ, and even just being really just the PM SPX options. And it kind of created this that cascade effect that just was a nonstop, like I say all the time, it's like a sell all day type of pattern. You kind of see that when it comes to kind of the flagging patterns, the really unconvincing highs that are being made intraday. I stayed short all the way to the end of the day and let the options just expire wherever they're at, because I didn't really care to try to trade the highs, lows of intraday. I just stayed short. I was short IWM, I was short QQQ, and it worked out okay. It wasn't saving my portfolio, but it worked out okay to the point where those options, they about tripled in value, to quadrupled in value over the course of the day. So that was fine. And I did warn everybody last weekend, it's going to be weak, inflation is going to be hot, and this could be just a correction for what people thought was, headline inflation is high, core is down, I get it, from a month-to-month basis, on a 3-month basis, on a 6-month basis, on a 12-month basis, core is looking pretty good. Now, I think what I want to do is bring up the CME Fed Watch tool. And we looked at this last week or earlier this week, and now you're basically seeing that September's FOMC meeting, basically they're saying it's almost even with the higher headline inflation, the consensus, this actually was going up for a no hike bet. So the bet for no hike just continued to increase over and over and over again. Let's look at the bet now. We looked at November before. November before was it was more like maybe 40-ish% that there wouldn't be a hike in November. Now, knowing that, let's look now, 72%. We have a 72% bet that that the interest rate that is current will not be changed. Okay? 1 week ago, it was 50% that it wouldn't be changed. So that's actually looking good. It's probably one of the highest bets that we've seen for a no hike in November. And if you just so if you want to know, December, it's still vastly consensus that it's going to be no hike. How about going into next year? We'll just take a look at this together. Vast majority, no hike. One person probably voting for a cut. And you can see that here in the 3.8%. If we go into March, current is still the vast majority, but you're starting to see the bets kind of lining up for your first hike being somewhere towards the end of Q1. It's not a big bet, but it's getting some bids right now. How about going into the doldrums of spring? And you can see now that the bets are getting higher and higher for a cut going into the second quarter. How about the middle of the year-ish? In the middle of the year-ish, current is 525 to 550, which is basically like 5.5% max. And you're seeing the bets kind of pile up. If you add these together, it's basically starting to become the majority. You might see one cut by Q1. And so these bets are kind of moving up. So you got to ask yourself, Mark, if you're showing me that stuff, let's go back to the charts and we'll take a look at what I'm going to talk about in a second. And it's like, Mark, if you're telling me that most of the bets are that, okay, there's no more hikes. So why is it that the yields are just relentless? Look, here's the long bond. This is the 30-year. And we're getting to the point where we wanted to see the long bond kind of cap out, and it didn't. We really wanted to see it kind of make this, second shoulder, this right shoulder on an inverse head and shoulders on TLT. This is the 30-year bond rate. So we're looking at the rate, not TLT. That it kind of broke through this kind of bull flag pattern, and it's actually pressing against 4.4%, looking like it's going to keep going up. We don't know, obviously. I don't know if it's going to keep going up, but it looks like a very bullish pattern. If this was Tesla and you saw this pattern, you're like, oh, this is Tesla. You would be like, I'm pretty bullish. But these are yields, and yields going up aren't necessarily great for stocks. Yields going up would kind of assume that there's a rate hike in the future. So how do you reconcile the idea that there is this there's more bets against no more rate hikes for the rest of the cycle, meaning for years, but all the yields are going up? Let's look at the 10-year. 10-year is out of our head and shoulders pattern now. It's kind of just like the 30. This is making a new high. It's pressing against up the previous highs very, very soon. You can make that move by Monday if Monday is weak, and the rest of the market, the rest of the month is seasonally weak. So what does that do for bonds? Why are they going up if the yields are essentially, the rate of the interest rate hike is likely off the table, and the Fed funds rate is what it is until maybe you get a hike within half a year. You get a cut within half a year. How do you reconcile this? Well, they're issuing a lot of debt. They're trying to build up the Treasury general account as much as possible. And now they're typically doing that without, really sacrificing the liquidity in the market. But if we just let's go back to the browser real quick. I just wanted to show another chart to kind of, illustrate this. So here's the reverse repo. This is the reverse repo for the middle of August until now, which is September 15th. And during August, you saw a very even level of the reverse repo account, and it was at $1.816 trillion. So within less than 1 month, we've drawn it down over $400 trillion in less than a month. So obviously this money is being used as liquidity to, purchase, treasury bonds, bills, what have you from the government. We do know, I understand completely that, we're letting a lot of these bonds that the government has purchased, we're not letting them roll over. They're just expiring and not being repurchased. So there's a, quantitative tightening working against, all this liquidity being injected into the markets, the bond market. But looking at the TGA, it's, okay. So we know that at the end of August, it was at $1.8 trillion in the reverse repo. And that is being drawn down to, either just be a reserve for the banks, or it's going to be, spent on buying, debt from the government. But the debt that got into the account was only about $100 billion, right? So we draw it down 400 something billion. It goes up 100 billion. I understand people are spending. I get that. But it kind of brings into question, like, so is there still liquidity that's being pumped into this market? Let's take a look at this article from Reuters. This is from Friday, yesterday. It says U.S. equity funds see the biggest weekly inflow in 3 months. So you're saying to yourself, like, I don't get it. But the market just sold off. But it's really more about positioning. It's really about, slowly getting into a position because you're trying to capture the long side, right? You're trying to capture a low, be it, and no one knows, seasonality wise, yeah, it makes sense that October is going to be the low and that's where you want to go long. But you need to be positioned because you don't know how the market's going to respond to what some people say is, a front-loaded weakness of September. So there are some statistics that say, the front-loaded weakness that goes into September can kind of adjust the bottom of the market. There's not much evidence for it because most of the Septembers and Octobers, they're not that great. But in those small sample size of decent months, that move up, right, is going to be, if you're not positioned for it and you're already underperforming the index, you're going to get some people kind of putting some money in, just getting their position started, because a lot of people have been sitting in cash, sitting in bonds, and what have you. One of the effects of people getting positioned for this and spending billions of dollars buying these are just this is tracking equities, bonds, and money markets. And yeah, I understand there's a lot of money in money markets, but that's actually going to be fuel for the fire come whatever low is in September or October. But the money that's being pulled out, being reserved with some type of liquidity for a move up. I mean, I think that rotation's happening. The thing about it is, how do you capture that movement? We don't know. You just have to be kind of positioned for it. Us retail investors, we don't really have the opportunity to be like, I'm going to hold $1 billion in cash. I'm going to put, a couple $100 million in now. So I'm kind of in. If it moves up, I'm in already. No, we have like a couple $100 to spare. We've invested for the past, X number of years, and you're like, we're riding through the volatility and it sucks. But, the people who are trading or managing money, they have a lot of money to play around. And so it's going to be interesting to see if what's going to happen is that you see money being pulled out of bonds. You're trying to keep the yield down by, pulling down the reverse repo. So you use those funds to purchase bonds, but people are selling bonds so they can get into cash, so they can get ready for the bottom. And then the reverse repo, the interest on the reverse repo is kind of flat, right? So the government's almost implying that, we don't really want to encourage you to keep the money in this account. And that's one of the reasons why the flows are possibly coming out, because, maybe you just capture a short-term upside move on like a 1 month bill. And then after that 1 month is over, you get your money back, you buy into the S&P 500 in like the lows of October. It lines up perfectly, right? It lines up for a really good move to the upside. And because, the rate is competitive to holding money in the reverse repo if you're a bank, right? Very similar rates. Let's go back to the chart. So we're seeing yields go up. So so the yields go up, and they could keep going up as people start getting money out of that market. So, the banks are essentially asked to buy bonds. But if you're not a bank, you're just a fund manager, you want your money back. And you're going to sell bonds. You're going to sell them every time it dips, you'll sell and maybe try to get as much of a cash position, or even just buy really short-term bills and get ready for the bottom that could happen. I'm not saying it's going to happen, but it could happen. So once again, we'll take a look at the seasonality before we go to the UAW kind of stuff. So if it's not convincing, I don't know what could be convincing. You got weakness for the next 2 months after August, right? So August sees a high, sells off. August sees a high. This is the high in September 2nd, September 1st, sells off for about, over a month. Here again, this is 2020, high beginning of September. A little bit of relief in the middle of September, continues to sell off. Here you get the relief in the middle of September, sells off. Here you see weakness at the beginning of October and a low at the end of October. And so you can kind of see how sometimes it does shift as far as where that low is going to be at, which is the end of October instead of the middle. But it was strong until it was strong until the beginning of October in that particular time. Just something to keep in mind when you're looking at the potential for downside. I'm just basically saying temper any optimistic projections you might have, and it might make you a better trader over the next couple of weeks. So let's pretend we don't know that this chart is General Motors. It's General Motors. It's on the hourly chart. It's going back for about, 2 months? So if you saw this chart just objectively, what would you say to yourself? Like as a Tesla investor, if let's pretend this chart's Tesla out of all the charts, and you saw this pattern, it sold 18% to the close yesterday over the course of 2 months. Would you look at this and say to yourself, like, oh, like, look, I think it's bottoming out. I mean, it looks like a double bottom, right? It looks like some people could call this like a double bottom. Maybe this is a perfect wick-off accumulation pattern, right? You have, maybe this is your spring and it's getting bought up. This is the river and it's going to just jump up. And you're trying to say to yourself, like, yeah, I'd buy that chart. Honestly, I might buy that chart. I might. You have a strong sell-off. You have a consolidation for what? A month? Like a month. This is August 14th over here on that sell-off. And so you're consolidating for 4 weeks. I would have bought this chart. In any scenario, I'd have been like, at least try. At least, I would have like a stop loss, maybe 3 or 4% stop loss, a 5% stop loss. Just if it meets that low again, I'm out. It's fine. I'm out. I'm not going to do it anymore. But there's some conviction to that trade because it just looks, from a technical aspect, it just looks okay. It looks okay. Okay. Now we know that it's GM. What do you do with that information now? I mean, the chart doesn't necessarily look terrible after the sell-off. How about we just zoom out a little bit? You're like, oh, okay, it's sold off from there, but it's actually it's basically at the same low it was in May, which is the same low as it was in December last year. The same low as it was in October, the same low it was in June of 2022. So you're putting in this floor of pricing. So what do you say to this? Now, is this kind of a bear flag pattern to you? Well, let's keep kind of moving around this chart. Maybe this is the pole right here. What does this chart look like to you? Now, you have a pole, you have a flag. Reminds me of Google from last year. I don't know if it does. Actually, it kind of does. I think Google is more flat. So now that you zoom out, you say to yourself, what do you think it looks like now? To me, it looks like double top into a bear flag, with a bear flag making a lower high, looking to what? Create resistance over here, basically. Maybe find resistance. Consider this kind of like a support resistance area where we'll zoom in again so you can kind of see that. And we'll just draw a line. Maybe we'll say like this is going to be the important zone to capture. If this consolidates on Monday, if this starts moving off this area on Monday, because it kind of bounce around on that on Friday, you can see that there. It's kind of bouncing around that level, which is basically the bottom of the range over here, top of the range over here at the previous low. So it's hard to say, like everyone's saying, okay, the UAW is striking. Why is Ford and GM outperforming Tesla? Shouldn't they just be super red? So then did they down 13% like it was in 2019 in that chart you showed us yesterday? Or I'm sorry, the day before yesterday? Maybe, but you kind of had to put it in perspective. You see it two ways. Number one, when you zoom out, you see that the stock is pretty oversold. Let's go back out again. The move from, let's see, December 31st, 2021 to the close, it's been 50%, right? You're basically at the same price it was pre-COVID. And as far as the low, we've seen lows somewhere in the range of, 52%. So the question you have to ask yourself is, GM had a great last quarter, as far as profit goes. Sales are just fine. I know their EV stuff sucks and you're losing money on it. But when you just think about their internal combustion engine vehicle, the core of their business, which is the vast majority of sales, if you're looking at the immediate term, they're doing a decent job of making money. I'm not saying that they have a great future, but just if you're short GM, I would recommend this. And this is not financial advice, just a simple recommendation for people who are already in the trade. Try to consolidate your options. If you're shorting via puts or what have you, I would try to make them in the money as much as possible, right? I try to just make it a safer trade than some gamble that's out of the money that you might lose everything on. To the COVID low, it's a 50% move. I kind of understand that. That would be a really nice move to capture. But let's look at this on a daily time frame. Now, RSI is pretty oversold. And usually at this area, at least at the worst, it consolidated right here where it kind of stayed flat underneath the median. And it just consolidated for that time. You could even say this is at the bottom of a range where it's finding a base. And that's the thing about bear flags. It's like, is this basing or is this a consolidation? What is this move that I'm seeing? Is this going to blow up to the upside? I'm not saying there's great news that would send the stock flying to the upside, but you can kind of understand why the weakness that you might have expected really wasn't there immediately. I think what the market needs to see is they need to see how this strike progresses. Now, we know that each of the main manufacturers, GM, Ford, and Stellantis, has one factory that's currently being striked, and it's a key factory for them. Ford has some type of assembly, paint, final assembly that's being that workers are striking, and the other two manufacturers have some pretty important vehicles that are made at the factories that are being striked. So, what do you do with that? It really is. Does that really affect the overall ability to turn out, hundreds of thousands of cars? Maybe not, except for maybe Ford. Maybe Ford, that's why Ford is a little bit weaker compared to Stellantis and GM when you look at the action on Friday. I mean, let's just find out if that's true or not. Let's just overlap them. So we'll do Ford, and we'll throw Tesla in there too, just for fun, and Stellantis. And then we can try to understand from a very objective point of view, how this is working out. So let's go to an hourly chart. And we'll start July maybe? Okay, we'll move the chart so that left side is July. And this is crazy, right? Tesla is being outperformed by Stellantis. Now, because the strength that you saw in Stellantis on Friday is because they don't have maybe the same type of exposure. They have that automotive group has a wide range of vehicles being made across the world. GM and Ford are much bigger players when it comes to stateside, and that's why you can see how GM and Ford are kind of lower in this comparison than Tesla and Stellantis. So if you're looking for that short, Stellantis might be more resilient, maybe, right? From the looks of it. Also, you can say it just has more to fall, but from when you zoom out, those manufacturers they've been pretty oversold. Oh, I hate Tesla on this chart. It looks terrible. But they've been pretty oversold, right? Ford's high is over here. How much is Ford down to the close? Ford's down 50%, guys. Is that not enough? Stellantis is actually really flat. You can see Stellantis on this yellow part of the chart, the yellow line, it's pretty flat. Because, like I said, the exposure is a little bit different than GM. Just to remind you, GM, once again, also 50% down. That's for fun. We'll measure Tesla. Tesla's 30%, 33% down. You can probably, it's crazy when you really think about it. Like a 33% move for Tesla can be done in a week. But anyways, so knowing that, it can kind of explain why the way you thought price action was going to work out on Friday, it just wasn't there. It just wasn't there, actually, to the point where there were some pretty violent moves to the upside over the past couple of days. Pretty violent moves. Like these, let's just measure GM from a bottom to its current high. So this is like a double bottom move, and yeah, it's 6%. A 6% move since the 7th of September. If you would have captured a 7%, 6% move in a little over a week, you would have been happy. And that would have been a trade in GM, right? Like crazy. But yeah, so that kind of explains it. What you want to find out is, how is a UAW strike going to develop? Is it going to be affecting more factories? And maybe try to do some research on type of inventory levels that they're working with. I do know that they're having problems, delivering cars from their factory lots to dealerships. They were incentivizing dealers to actually send trucks to their factories, pick up the things that they want, bring it back to a dealership. There's just a logistics issue going on with the distribution of cars. And so that kind of means that there is inventory somewhere, and you also don't know how much inventory has been made in the build-up and anticipation of this strike. You gotta ask yourself, is that it's not like the strike was a surprise, right? So it wasn't a surprise. What if this move from July was simply a de-risking for the strike? That's a 17% move down in 2 months. Is that not enough? Of course, for me, I want it to be much lower for them. I'm completely biased, and maybe you are too. But just kind of look at it in a rational way. In 2 months, they're down 17%. They're 6% off the lows. Is this a wick-off pattern? I don't know. We don't know how much of this is priced in already. You just don't know. And so if you are short, I would recommend, rearranging your puts to be in the money puts, maybe fewer options, a lower options count, more in the money. So at least you can try to get out of it with something to spare, right? So those things don't go to like 1 cent options and you're like, oh man, right? Okay, so we'll go back to Tesla. Tesla's move, obviously, we don't know. I do want to kind of move my EM and kind of show you guys where I have it calculated at. I like to just kind of, when I kind of calculate the move, I won't really put them at the exact number. So if it's going to be like a 250, like 256 and 37 cents for a low, I'm going to probably try to move it towards 255 or to a round number. Because you can see how Tesla really respects that. You can see this last, I don't know if you guys are watching the close on Friday, that last ditch attempt to get the 275s paid out. That was close. It was a really quick sell. There was a lot of orders placed there, but it was close. They're really going for that just to get all the 275s paid for. That would have been great for me. Not that I was positioned for it, but higher the better, right? Higher the better. Okay, so I'm kind of considering the max moves go around 290 for the top side, around 256 to the bottom. So, and depending on how Monday opens up, you can kind of position yourself for what could be, quick reversals to the downside if the market continues being weak as seasonality shows it. And if you see a really sharp move lower, knowing that Tesla has a little bit more resilience than the S&P 500 during the weakness of September, you can kind of use that as a decision to, is this where I buy my upside hedge, etc. Right? Remember, I always like to say all the time, when you own Tesla shares, you're already long. You don't always have to go like super leverage long just because you like Tesla a lot. The stock is so volatile. You saw it on Monday. It's so volatile. It moves like it's an option, right? It moves like an option. If you buy one stock for $275 and it goes up 20% in the course of the week, it's almost like you're owning an option. Like you don't really have to think about a leverage play in Tesla when it's acting like a leverage ETF. Like it's acting like it's the TQQ, right? Okay. Thanks so much for listening, guys, and have a good weekend. Take care. Bye.